So the demand's returning for the investment side of the market. What about the pre-leasing side? I mean, from what we hear anecdotally, there is more demand in the marketplace, but can you give us a bit more of an insight into exactly what's happening there?
Yeah, most definitely. We've seen that from a pre-leasing point of view, there's been strong interest coming back into the market, particularly from the retail sector. So, inquiry anywhere from sort of 10,000 and above, and it seems to be a trend forming that it is coming from the retail sector, but that was probably highlighted most recently by the Kmart deal, which was a 78,000 square metre pre-lease, which again was indicative of a number of the retailers who are looking to consolidate sites into one site, get better synergies, better efficiencies within their business. So that was probably the best example of that we're seeing good, strong, or improving demand from the retail sector in particular.
Are there any locations where these requirements are seeking, or is it just back to the traditional close to infrastructure style locations?
Most definitely infrastructure. So as it turns out, the Kmart deal was done in outer Melbourne and the western outer Melbourne, but that's not to say there's not inquiries throughout the southeast and northern regions of Victoria. Pre-leasing has been quite strong in the western regions of Melbourne, so I guess the lion's share of that has actually ended up out there.
Okay, so the pre-leasing being so important in the process of development activity and really creating investments as well. It needs land too, of course, and when you come to Melbourne, you always get this story. Melbourne just has too much land, and you're never able really to absorb it all. There's too much competition. But of course, there's really two types of land, isn't there? I mean, one is in globo land that's unserviced, and then there's serviced land as well. I understand at the moment there's quite a difference in the supply of those two things.
Oh, absolutely there is. And for those who have come from interstate today, there's not too much land, particularly that's serviced and available. And given that we've seen such strong inquiry, particularly through the middle of 2009 through to the current day, serviced land is critically important to owner-occupiers who don't necessarily give themselves the appropriate lead-in time to build their own facilities. We're talking more on a smaller scale. So a great example of that is the West Park Industrial Estate out in Derrimut. Through the first half of 2009 there was 3 lots sold, and from the middle of last year to the current day there's been another 31 sold. So that's a particular example of Australian in that particular instance capitalising on being available, being ready and being open for business.
So I suppose in some ways, we're seeing it in the office markets definitely, where there was no new building started for probably 2 years. I suppose in an industrial environment, starting a new estate or putting services in is a similar thing. And so now you're dealing with the undersupply, if you like, as projects didn't get underway over the last 2 years.
Oh, that's absolutely right, and I think that's where the opportunity going forward in 2010 is for developers who do own large tracts of land in various locations to seriously consider looking at getting them underway, whether it be selling super lots to second and third tier developers who we've also seen are coming back into the market in a big way and now looking to actually to acquire land again, and they've been absent for quite some time. So that's where we see the opportunities.
Okay, so it's interesting that the institutions owned the land before the downturn and were able to hang on to it during the downturn, which means that they will probably become, I guess, the predominant developer again. And is there a role for the private developer in all of this?
Well, there is. I think that generally speaking, in broad terms, an institutional developer is probably more seeking the 10 to 15 plus thousand square metre inquiry, where the second, third tier developer is looking for something a little bit smaller, and they can also turn things around much more quickly. So there's definitely a place for all parties in those markets.
Okay. So why don't we wrap it up now and just try and pinpoint some of the key opportunities you see in the industrial market in the year ahead, in this year of in this year of recovery?
I think, as I alluded to previously, I think it's critically important to let the market be aware that you're actually open for business and available to do deals, and also seriously consider either opening up new land subdivisions, looking at perhaps talking to second, third, fourth tier developers and taking out larger tracts to be able to get you off the ground. So I think if you can be there first, or one of the first few to actually be out of the ground, great opportunities to capitalise on the current groundswell of inquiry.
That's good advice. Time to get moving by the sounds of things.
Absolutely.
All right, that's great. Thanks very much this morning, Walter.
Thank you.
Now we're going to turn to the retail sector, and as it's panning out, if we had to use a 10-second grab to describe how the retail sector fared over the last 2 years, we'd have to say it really is the resilient sector. It's been extraordinary how well the retail sector has held up, and then of course how well it's held up in Melbourne and Victoria. This is best shown in some of the total returns numbers that have come through recently from IPD. You can see on this chart a comparison of the prime CBD office market and the retail regional shopping centre market and the prime warehouse centre. I've lost my monitor up there, so I'm just going to walk around for a little bit. You can see here that the regional shopping centre market has fallen in total return sense in just 1.5 percentage points, whereas CBD has dropped about over 10%, and warehouse around 9%. This has really been caused by very strong income growth through the shopping centre market, and that's very much thanks to Kevin Rudd and an extra $12 billion of funds that came through the economic stimulus plan last year. It effectively added another trading month to the year of 2009, and it held total returns up at a much more respectable rate. But this year we really see, perhaps different to the other sectors, we really see a year of a sector that's going to be pulled from both directions. We're going to see a lot of upward pressures for retail. We're seeing increasing employment, obviously good spending going into the retail market, increasing wealth effect as confidence improves, house prices are rising and share markets are improving, the superannuation funds are coming back. We're also seeing a higher dollar, which will lower the price of merchandise. So again, we start to see that effect of goods flooding in through the ports and shoppers are happy to spend because they're feeling good about themselves. But there are some pretty strong headwinds against retail as well. The important one is interest rate increases, and we do think interest rates will increase to about 4.5% to 5% by the end of this year. Household budgets will start to become stretched, and this will impact retail spending. The other thing too is that the government stimulus package, the other component of it, is yet to fade away. It's timed, of course, to fade away just in time for the next federal election. But things like the education building program, the infrastructure program, these things will fade away this year, and it will cause somewhat of a downturn in some parts of the economy. Now, I think it's interesting. Some people will read this the wrong way. I think the downturn will actually be the double dip. I don't think it will be, but I think you'll see a shift in what's going on. Rather than an economy that's pumped up, you'll see the natural economy start to return. But there will be some moments where you think, we're going for the double dip. But nonetheless, there is pretty strong headwinds there for the retail sector. Now, one thing that we've noticed in our monitoring of the various sectors that we cover for vacancy in retail is that the vacancy rates in retail are still extraordinarily low. And so if we do get some more demand for space now, it's almost impossible to satisfy new tenants in the market, and it's likely to push rents up. CBD vacancy rates are about 1.5%. The prime strips that we monitor have come down as well in the last 12 months, and they're now at about 3%. Bulky goods have had their ups and downs, but at the moment the vacancy rate there is about 1%. So it means that these conditions, again, a bit like the office market, are ripe for increase in rentals as the vacancy rate is just so low. We saw in the last 12 months that the stronger retailers really were expanding into locations as the weaker ones fell away. So we do in some ways have a very strong retail market on the tenancy front. So what it means for retail spending, the assumption is that even though retail spending will continue to grow this year, it will grow at a much lower rate in Australia as well as in Victoria, although again Victoria will actually be growing above the national averages. It's a pretty common theme that we see in just about every indicator. Again, Victoria growing above national averages.